So this is the last tutorial of the three-part series of what is technical analysis, and in this tutorial I'll be explaining about the three main assumptions of technical analysis, and I will be giving you an example explaining all what I've taught in these three tutorials. So first of all is the assumptions of technical analysis. So there are three main assumptions of technical analysis, and these are: the market discounts everything, second is price moves in trends, and the third is history tends to repeat itself. So let me explain first of all the market discounts everything. So actually fundamental analysts argue that the business fundamentals are the deciding factor in judging a company's value, and then you can know the share price has upside or not. While technical analyst tells that at every point of time, prices of a stock or prices of a share reflects all the information of a company's financial well-being. And that's why there's no point in analyzing financial statements. So the price you see reflects all the information of a company, and you shouldn't be focusing on the financial statements. And this is the first assumption of technical analysis, that market discounts everything, and that is shown in price of a stock. Now the second is prices moves in trends, which basically means that price movements from day to day are not random events. Rather, price movements, if shown in the form of a chart, represents various patterns which give signals to buy or sell. This means that after the trend or pattern has emerged, then the future direction of a stock is highly predictable. And that is why technical analysis says that the prices always moves in trends. It may be in a downtrend, or it may be in an uptrend, or there's a sideways pattern also. But basically prices moves in trends. Now coming to the last point, that is history tends to repeat itself. So if a pattern has emerged which is a bullish pattern, or basically it gives a signal that the stock is set for huge upside, then it is likely that it will occur in the future also. And if the same happens, then again the stock will rise. Actually, the reason is, when similar patterns occur, that means that investors tend to show similar emotions in certain situations, and that's what is shown in a price movements. So for example, if a stock price falls 10% on the news that the managing director resigned, then people get a bit scared. So people had similar reaction, that is fear. Similarly, when everybody is buying, then the emotion is greed, and these emotions let humans do the same thing again and again over time, which eventually makes price patterns. So these three were all the basic assumptions of technical analysis, which everybody should keep in mind, because technical analysis is based on all these things. So now let me just give you an example of what I have explained in all the three tutorials. So for example, an investor named Jerry is a technical analyst, and he sees a stock Google. Now as he is a technical analyst, he uses chart. So he looks after the chart of Google, and now looking at the chart, he sees a pattern that Google is set for a huge run up, because he has seen a similar pattern in different stocks, and that pattern has proved right. So then he looks after the volume to ensure that the pattern is not showing a false picture of the stock, because just like you do all the analysis by studying financial statements and all that stuff, then also there's a chance that you can be wrong. So similarly, chart patterns are also wrong. But Jerry, in order to ensure that the pattern is true, checks the volume of the stock, which is going accordingly. So now he moves on to the indicators. Although there are a lot of indicators, but his favorite is 50-day volume indicator, which tells about the volume of the stock, which ultimately tells that whether the stock is in demand or not. And his second favorite indicator is the Arun indicator, which is used to measure whether a security is in an uptrend or downtrend and the magnitude of that trend. So now, after analyzing a pattern and going with the volume and the indicators, charts give him a buy signal that the chart is good and he should buy the stock. So finally, he buys the stock and makes a profit from that. And this is what basically technical analysis is. And I haven't explained technical analysis in very deep because it's basically a very diverse topic, and you can take an idea that 6 to 700 pages books are written on this subject. So I have just given you an idea of what technical analysis is. But if you want to dig deep, then you can just go for the books and stuff like that. Also, I will be starting various courses on stock market which would explain all the concepts in detail, like technical and fundamental analysis, because they need their separate attention, after which you will be able to understand advanced stuff. So this is the end of the 3-part series, but if anywhere you didn't get anything, then just please ask me in the discussion forums and I'll get back to you as soon as possible.